Warren Buffett has consistently advocated for the enduring value of staying invested in stocks, adhering to the philosophy of being cautious when others are overly confident and seizing opportunities when others are apprehensive. However, amidst his renowned sayings, it's essential to recognize that Buffett has also shared insightful perspectives on how inflation can impact stocks throughout his life. Today, we are going to discuss Warren Buffett's proven strategies for investing during inflation. As inflation once again becomes a focal point for investors grappling with a rapid market correction, it is valuable to revisit Buffett's past statements on the subject. During the late 1970s and early 1980s, when the United States experienced high inflation rates, Warren Buffett dedicated considerable sections of Berkshire Hathaway's annual letters to examining the implications of rising prices on stocks, corporate balance sheets, and investors. Buffett navigated and invested through a challenging period when inflation reached 14% and mortgage rates surged to as high as 20%, marking what some consider the most significant macroeconomic failure in post-World War II America. His focus on and concern about inflation persisted. In June 2008, amid escalating gas prices exceeding $4, Buffett identified exploding inflation as the foremost risk to the economy. Expressing his views on CNBC, he emphasized the significant impact of inflation on various sectors, such as steel and oil, stating that inflation was substantial and pervasive. Do you recall the subsequent events? In 2010, amidst the Federal Reserve's continuation of its quantitative easing program, Warren Buffett expressed gratitude to the government for its decisive actions in overcoming the crisis, conveyed through an oath. However, he also issued a warning that the policies in place, unless altered, could eventually lead to significant inflation in the future. Buffett emphasized the perilous path the country was treading and cautioned about the potential consequences. As the markets experienced a downturn in the recent 2 weeks, headlines suggested that the realization of the conclusion of the central bank's era of easy money was finally sinking in. Back in 2013 at the Berkshire Hathaway annual meeting, Buffett had already forewarned about the uncertainties associated with quantitative easing, likening it to watching an unpredictable movie, with investors likely to reassess their positions swiftly when the situation unfolds. In a seminal article for Fortune magazine in 1977, Warren Buffett elucidated his perspective on inflation, asserting that it is a more destructive tax than any legislated by governments. He highlighted the profound impact of the inflation tax, emphasizing its ability to erode capital significantly. Buffett cautioned against the belief that one could strategically navigate securities to outsmart the inflation tax, stating that while he would be willing to be a broker, he wouldn't want to be a partner in such an endeavor. Today, the world and the economy differ significantly from the time when Buffett addressed inflation in his annual letters to Berkshire Hathaway shareholders. Changes in income tax rates, bond yields, and savings rates have transpired. The current environment is marked by the initial indications of inflation, notably observed in the recent rise in wages reported in the non-farm payroll report, and the Consumer Price Index exceeding expectations in the latest data released on February 14. Several economic factors are strikingly reminiscent, at least in part, of the Vietnam War era. In that period, the government's rapid escalation of the federal deficit set off an inflation cycle that reached its peak in the late 70s. Presently, forecasts from a government budget watchdog indicate a doubling of the annual deficit, projected to increase from $600 million expected just 2.5 years ago to $1.2 trillion in 2019. This surge is attributed to tax cuts and a recently approved spending package. It's essential to recall that the most significant stock market downturn of the 1970s occurred not at the peak of inflation, but when it initially spiked abruptly. Between 1972 and 1973, inflation doubled to over 6%, reaching 11% by 1974. During these 2 years, the S&P 500 witnessed a collective decline of 40%. Although inflation was higher in 1979 and 1980, peaking at 13.5%, the S&P 500 had already returned to positive performance by that time, albeit on an inflation-adjusted basis. Despite this, it marked a challenging decade for stock performance. Buffett, being a seasoned investor, is well suited to elucidate the fundamental mechanisms in play when stocks confront inflation. In one of his letters from the inflationary era, Buffett highlighted a fundamental challenge. Berkshire has no corporate solution to the problem. Inflation does not enhance our return on equity. In essence, Buffett emphasized that inflation poses an intractable issue, and there is no corporate remedy within Berkshire's control to improve the impact of inflation on return on equity. Buffett has consistently recommended investing in businesses that generate substantial returns on invested capital. In periods of inflation, businesses with lower capital requirements, capable of sustaining their earnings, are likely to perform better than those compelled to invest increasing amounts just to uphold their standing. Buffett illustrated the difficulty posed by inflation as akin to running up a down escalator. Buffett emphasized the critical significance of pricing power when evaluating a business during a testimony to the Financial Crisis Inquiry Commission in 2010. According to him, a business with the ability to raise prices without losing customers holds a substantial advantage and is considered a strong business. In times of high inflation, businesses that can increase prices gain a significant edge as they can counterbalance their rising costs. Buffett illustrated the ideal asset in an inflationary environment as an unregulated toll bridge, citing its advantage of having already been built in older dollars. In such a scenario, the owner can raise prices to counter inflation without the need for continuous replacement. Buffett recommends Treasury inflation-protected securities as an investment option for those wary of increasing inflation. TIPS provide investors with a biannual fixed interest rate, and the principal amount is adjusted based on inflation, as indicated by the Consumer Price Index. Buffett advised shareholders in 2004 that investing in one's own skills is a highly effective strategy for preserving purchasing power over the long term. He highlighted the advantage enjoyed by professionals, such as top surgeons or lawyers in a city who benefited from education funded with old dollars, but can charge fees in current dollars without the need for further education. To enhance your professional profile, consider expanding your skill set through online resources or local educational institutions. While pursuing advanced degrees may involve costs, the resulting increase in knowledge can make you an invaluable asset, positioning you as an indispensable employee in the future. By continually augmenting your value to your employer and its clientele, you can ensure a fair and competitive compensation over time. In his 2020 letter to Berkshire's shareholders, Buffett expressed a lack of enthusiasm for bonds, stating that they are currently an unattractive investment option. Given the persistently low interest rates, bond investors may face substantial challenges in an inflationary setting. Buffett highlighted the comparison of purchasing a 10-year bond with a 2% yield to paying 50 times earnings for a business. The crucial distinction lies in the fact that the bond's earnings cannot experience growth. He also pointed out that fixed-income investors globally, including pension funds, insurance companies, and retirees, confront a dim outlook for the future. Charlie Munger, Warren Buffett's business partner and vice chairman of Berkshire Hathaway, offers his perspective on dealing with periods of high inflation. In 2004, he advised Berkshire shareholders that a significant defense against inflation concerns is to minimize unnecessary needs in one's life. That's all about today's video. If you like this video, don't forget to like and subscribe to our channel. Also, press the bell icon to get notified of our upcoming videos. Let us know your opinion in the comment section below.